Welcome to Gainverse, where we break down gold and silver markets in a clear, honest, and realistic way. Today's video is extremely important because while silver prices are exploding and headlines are screaming excitement, something very different is happening behind the scenes. Silver may look strong on the chart, but confidence in the physical market is not matching the excitement you see online. Over the last 3 months, silver has made an incredible move. Just a short time ago, silver was trading in the low 40s. Today it is trading close to $64 an ounce. That is a move of more than $20 in only 3 months. To put that into perspective, silver has gained more in 3 months than its entire spot price was less than a decade ago. Moves like this naturally create excitement, bold predictions, and talk of triple-digit silver. But excitement and confidence are not the same thing. In this video, instead of focusing on predictions, we are looking at real-world behavior. What people are actually doing matters far more than what they are saying online. To understand what is really happening, I looked at the physical silver market directly. I contacted multiple local coin shops across different parts of the country and checked several large online dealers that publicly list their buyback prices. What I found was eye-opening. Let's start with silver rounds. These were clean, retail-friendly 1-ounce rounds, not damaged or tarnished pieces. Even with silver trading near $64 an ounce, the best offer I could find was $4 below spot. Most dealers were paying $5 to $6 back of spot, and one was nearly $7 back. That means if silver is $64, some dealers are only willing to pay around $57. This alone tells us something important. Coin shops are not pricing silver as if they are confident the current price will hold. They are protecting themselves, and this is not unusual behavior when prices rise very quickly. Dealers operate on thin margins. A 5% move against them can erase their profit in a single day. Now let's talk about silver eagles. In the past, silver eagles often held strong buyback prices, sometimes even at spot or slightly above. That was not the case here. The best offer I could find for 1-ounce silver eagles was $1.50 below spot. Many were paying $2 to $3 back, and one online dealer was paying $5 below spot for brand new, retail-friendly eagles. That is a major shift. This tells us something critical. Dealers are not confident enough to pay up, even for the most recognizable and liquid silver products in the market. This does not mean silver is weak. It means dealers are worried about how fast the price has moved and what might happen next. There are two major reasons for this caution. First, silver's move has been extremely fast. A $20 move in 3 months is not normal behavior. Even in strong bull markets, this kind of acceleration usually leads to volatility. Dealers remember 2011. They remember what happens when silver runs too far, too fast. Whether or not today is the same situation, that memory still influences behavior. Second, there is a flood of physical silver coming into shops right now. High prices bring sellers out of the woodwork. People who bought silver years ago at much lower prices are taking profits. Coin shops are buying a lot of metal, but they are not selling enough to balance it out. That means excess inventory must be moved to wholesalers or refiners. Here's the problem. Wholesalers and refiners are not paying spot either. In many cases, refiners are paying $1 or more back of spot for rounds, and only near spot for eagles. That creates very thin margins for coin shops. If a dealer buys eagles at $1.50 back and can only sell them near spot, they are exposed to price swings immediately. A small overnight drop wipes out their profit. So what do dealers do? They widen spreads, they lower buyback prices, they protect their business. This is not manipulation. This is risk management. Another important signal is what refiners are refusing to buy. Many refiners are no longer buying sterling silver or 90% silver due to massive backlogs. Some coin shops are refusing these products entirely. This tells us there is too much metal moving through the system too quickly. All of this points to one conclusion. While silver prices are strong, confidence is mixed. The market is not unified in its belief that prices will continue straight up. Some people are buying, many people are selling. Dealers are cautious. Refiners are overloaded. This does not mean the silver bull market is over, but it does mean risk has increased, especially for short-term buyers chasing price. To understand what is happening right now in the silver market, we need to put ourselves in the position of a dealer. Coin shops and large online bullion dealers are not investors. They are businesses. Their primary goal is not to predict where silver will be next year. Their goal is to survive daily price swings and protect their inventory from sudden losses. This difference in mindset explains a lot about the behavior we are seeing. When silver rises slowly and steadily, dealer confidence usually improves. Spreads tighten. Buyback prices move closer to spot. Dealers feel comfortable holding inventory because they believe the risk of a sudden collapse is low. But when silver rises extremely fast, like it has over the last few months, the opposite happens. Confidence drops, even though prices are higher. This may sound counterintuitive, but it is very logical. A fast rally increases uncertainty. No one knows where fair value is in the short term. Dealers know from experience that markets rarely move straight up. Sharp rallies are often followed by sharp pullbacks. Even if the long-term trend remains bullish, short-term corrections can be brutal. For a dealer holding hundreds or thousands of ounces, a $5 overnight drop is not a small event. It can erase weeks of profit in a single session. This is why dealers widen spreads during fast rallies. It is not because they are bearish on silver long-term. It is because volatility has increased. Wider spreads are a form of insurance. By paying less on the buy side, dealers create a buffer that protects them if prices drop before they can move inventory. Another factor adding to dealer stress is inventory flow. When silver prices jump quickly, selling activity increases. People who bought silver years ago at much lower prices suddenly see an opportunity to lock in gains. This creates a surge of metal coming back into the market. Coin shops become buyers, but buyers only up to a point. The problem appears when selling overwhelms demand. Dealers can only sell so much retail silver to customers each day. Any excess must be sent to wholesalers or refiners. If refiners are already backed up or lowering their own bid prices, the risk to dealers increases even more. This forces dealers to be cautious and defensive. This is exactly what we are seeing now. Refiners being selective about what they buy is a major signal. When refiners stop accepting sterling or 90% silver, it tells us the system is congested. Too much metal is moving through the pipeline too quickly. This does not mean silver is unwanted. It means capacity is limited and risk is rising. Another important detail is the difference between retail enthusiasm and professional caution. Online forums and social media often amplify excitement during rallies. Price targets get higher. Confidence appears absolute, but professionals who have lived through multiple cycles tend to be more careful. They remember how quickly silver can reverse. This gap between public excitement and professional caution often appears near short-term peaks. It does not mean the bull market is finished. It means the market needs to cool off, digest gains, and rebuild confidence. These pauses are healthy, even though they feel uncomfortable. For stackers, this is where understanding your role matters. If you are holding physical silver for long-term protection, dealer spreads should not cause panic. They are a reflection of short-term risk, not long-term value. Physical silver does not lose its monetary role because dealers are cautious for a few weeks or months. However, for those buying aggressively right now, dealer behavior is a warning sign. It does not say silver is going to zero. It says risk is elevated. Buying during moments of extreme speed requires patience, discipline, and realistic expectations. Silver always provides opportunities, but chasing price often leads to regret. One of the biggest mistakes investors make is confusing price strength with market health. A healthy market is one where confidence builds gradually, demand is steady, and spreads remain tight. A stressed market is one where prices move fast, emotions run high, and professionals step back. Right now, silver shows signs of stress, not weakness. This distinction is critical. Silver can be in a long-term bull market and still experience sharp, painful corrections. In fact, those corrections are often what reset the market and allow the next leg higher. Dealer caution, wide spreads, and heavy selling pressure are often part of that reset process. When dealer confidence drops and spreads widen, physical silver stackers often feel uncertain. The headlines say silver is strong, but the real-world signals feel mixed. This is where discipline and clarity become more important than ever. Understanding what matters and what does not helps long-term stackers avoid emotional mistakes during volatile phases like this one. First, it is important to remember why physical silver is held in the first place. Physical silver is not a short-term trade. It is not meant to be flipped quickly for profit. Stackers hold silver because they do not trust paper systems to protect purchasing power over long periods of time. That core reason has not changed just because prices moved quickly or dealers widened spreads. Dealer behavior reflects short-term risk, not long-term value. When spreads widen, it does not mean silver suddenly became less valuable. It means dealers are protecting themselves from volatility. They are managing business risk, not making long-term price forecasts. Stackers who confuse these two ideas often end up reacting emotionally. Another important concept is price versus value. Price is what the paper market says silver is worth at a given moment. Value is what silver represents over time as real money. These two ideas can diverge sharply during periods of stress. When silver prices surge quickly, price becomes noisy and unstable. Value remains steady. This is why experienced stackers often say they do not watch daily price movements closely. They care more about fundamentals. Has debt stopped growing? Has money printing ended? Has purchasing power stabilized? If the answer to these questions is no, then the long-term case for silver remains intact. For stackers still accumulating, rising prices can feel discouraging. Fewer ounces can be bought with the same amount of currency. This creates frustration, especially for those who missed lower prices earlier in the cycle. However, this is a normal part of every bull market. Low prices allow accumulation. Higher prices validate the thesis. Both phases are necessary. It is also important to understand that stacking does not have to be constant. There is no rule that says you must buy every week or every month. During periods of extreme volatility, many disciplined stackers choose to pause, observe, and wait for better conditions. Waiting is not failure, it is strategy. Another mistake to avoid is chasing emotional narratives. When silver is rising fast, social media fills with confident predictions and absolute statements. People speak as if prices can only go up. This kind of certainty rarely ends well. Markets move in cycles, not straight lines. Maintaining skepticism during excitement is a strength, not a weakness. Physical silver also offers a psychological benefit that is easy to overlook. Holding something real during uncertain times reduces anxiety. That peace of mind is part of silver's value. If watching daily price swings increases stress, it may be a sign that position size or expectations are misaligned with personal comfort levels. For those who already hold significant silver, this phase is more about patience than action. You do not need to prove anything. You do not need to predict tops or bottoms. Let the market do what it does. Silver bull markets often take years to fully play out, with many dramatic swings along the way. One more important point is liquidity. During fast rallies, liquidity can disappear quickly. Dealers become selective. Refiners slow intake. Spreads widen. This is another reason not to make rush decisions. Liquidity improves after markets cool down. Panic selling into illiquid conditions often leads to unnecessary losses. In short, disciplined stackers focus on process, not price. They understand that volatility is part of silver's nature. They accept that dealer caution is a short-term signal, not a long-term verdict. And most importantly, they stay aligned with their original reason for owning silver. After an explosive move like the one silver has just experienced, many people start asking the same question. Is this the end, or just a pause before the next move higher? To answer that, we need to understand how silver bull markets actually behave. Silver does not trend smoothly. It never has. Pullbacks are not a sign of failure in silver. They are a structural feature of how this market works. In every major silver bull market in history, sharp corrections have appeared after fast rallies. In the 1970s, silver experienced multiple drops of 20 to 40% before reaching its final peak. The same pattern appeared in later cycles, including the 2011 run. These pullbacks were painful, emotional, and often convinced many people that the bull market was over. In reality, they were resets that allowed the trend to continue. The reason pullbacks happen is simple. Fast price moves attract short-term capital. Traders enter with leverage, momentum strategies, and tight emotional timelines. When prices stop rising, even briefly, that capital exits quickly. This creates sharp drops that feel sudden and violent. But this selling pressure is not coming from long-term holders. It is coming from traders. At the same time, fast rallies overload the physical market. Dealers build inventory quickly as sellers rush in. Refiners become backlogged. Spreads widen. This creates stress in the system. A pullback reduces this pressure. Selling slows. Inventory clears. Confidence begins to rebuild. In this way, pullbacks are not just price events. They are mechanical resets across the entire supply chain. Another important factor is psychology. Markets need time to absorb gains. When silver jumps $20 in a few months, expectations become unrealistic. People begin to assume that prices will continue rising at the same speed forever. Pullbacks break that illusion. They remind participants that markets move in waves, not straight lines. For long-term stackers, this is actually a positive development. A cooling period gives discipline back to the market. It separates emotional participants from patient ones. It also restores opportunities for accumulation at better conditions, even if prices remain higher than earlier in the cycle. It is also important to distinguish between a correction and a trend reversal. A correction happens when prices fall, but the underlying reasons for the move remain intact. A reversal happens when fundamentals change. Right now, the fundamentals that drove silver higher have not improved. Debt is still growing. Monetary policy is still distorted. Inflation risk remains. Industrial demand for silver has not disappeared. These facts suggest that pullbacks are corrections, not endings. Another signal to watch during pullbacks is behavior, not price. Are people panicking? Are headlines suddenly declaring the bull market dead? Are social media narratives flipping from certainty to fear? These are often signs that a reset is underway, not that the trend has failed. Markets tend to punish certainty in both directions. It is also worth noting that pullbacks help restore dealer confidence. As volatility decreases, spreads can tighten, liquidity improves, refiners catch up. This is how the system stabilizes after stress. Without pullbacks, the system becomes more fragile, not stronger. For those considering new purchases, patience during pullbacks is often rewarded. That does not mean trying to time the exact bottom. It means avoiding the urge to chase prices during vertical moves. Silver always offers opportunities, but they rarely appear when emotions are at their highest. Finally, pullbacks test conviction. They force investors to ask why they own silver. If the answer is short-term profit, pullbacks feel unbearable. If the answer is long-term protection, pullbacks are uncomfortable but manageable. Knowing your reason determines your reaction. As we reach the final part of this discussion, it is important to zoom out and look at the bigger picture. Silver's explosive move, the drop in dealer confidence, and the widening of spreads are not isolated events. They are all symptoms of a market that is under stress, because it is repricing something much larger than just an industrial metal. Silver is reacting to deep monetary issues that are still unfolding. The most important thing to understand is that silver's long-term story has not changed. Debt continues to grow. Governments continue to spend beyond their means. Central banks remain trapped between fighting inflation and preventing economic damage. These pressures do not disappear because silver pulls back for a few weeks or months. They are structural and long-term. Gold and silver tend to move ahead of broader recognition. They react before problems become obvious to the general public. When these metals rise sharply, it is often because confidence is quietly eroding beneath the surface. That erosion may not show up in headlines right away, but it shows up in asset behavior. Dealer caution is not a sign that silver is finished. It is a sign that short-term risk has increased. Professionals who have lived through past cycles know how quickly silver can reverse after fast moves. Their behavior reflects experience, not panic. Understanding this helps investors avoid misinterpreting caution as bearishness. Going forward, the signals that matter most are not daily prices, they are behavior and policy. Watch how governments respond to economic pressure. Watch whether debt growth slows or accelerates. Watch whether central banks truly tighten policy or quietly return to easing. These actions matter far more than short-term charts. Another key signal is public participation. Major bull markets usually end when everyone is involved and convinced prices can only go higher. We are not there yet. Most people still do not own silver. Many still trust currencies and institutions. This suggests that while risk exists, the cycle itself may still have room to run. For physical silver stackers, this phase is about patience and alignment. Staying aligned with your original purpose reduces stress and improves decision-making. There is no need to predict exact tops or bottoms. Silver is not about perfection. It is about protection. For those looking to add exposure, waiting for calmer conditions often makes sense. Volatility creates opportunities, but only for those willing to wait. Acting out of fear or excitement usually leads to regret. Discipline is the real edge in this market. In summary, silver's recent behavior is a message, not a verdict. It is telling us that monetary pressures are increasing and that markets are adjusting. Pullbacks, dealer caution, and volatility are part of that adjustment. They do not invalidate the long-term case for silver, but they do demand respect. Understanding this allows investors to approach silver with realism rather than emotion. The goal is not to chase price. The goal is to position thoughtfully in a world where money itself is being questioned. Financial disclaimer: this content is for educational and informational purposes only and should not be considered financial or investment advice. I am not a licensed financial advisor. Gold and silver prices are volatile and can move up or down based on market conditions. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. Past performance does not guarantee future results.